Let's talk about the traditional retirement model financial professionals use to guide people in retirement savings. The 3 pillars of retirement in Canada is a term for the trio of common sources of retirement income: Universal Benefits Old Age Security, OAS, Canada Pension Plan, CPP, Quebec Pension Plan, QPP, and Company Pensions, Personal Savings. The first pillar, Universal Benefits, is considered the foundation of Canada's retirement income system. You do not contribute to these universal plans. Taxpayers fund them via general tax revenues. OAS was designed to finance only a small portion of retirees' income needs. Guaranteed Income Supplement, GIS, is a monthly payment if you qualify. The great news is that this benefit is not taxable. Still, at the same time, this benefit may not be desirable for some people. It focuses on low income. It is available only to low-income Old Age Security OAS pensioners. Since the 1970s, GIS has remained an essential element of our universal, publicly funded retirement benefits. Another pillar covers earnings-related benefits with the Canada Pension Plan, CPP, Quebec Pension Plan, QPP. These public pensions are government-regulated and are funded mainly through required contributions from employers, employees, and self-employed individuals. These benefits look at age criteria and the amount contributed over a person's career. CPP differs from another government benefit, Old Age Security, OAS. Payments from OAS come from general tax revenues. Essentially, this contributory program ensures that you have a retirement income plan. If you have an employer, you pay half the required contributions, and your employer pays the other half. If you are self-employed, you make the whole contribution. That leaves our third pillar, personal voluntary savings. This final pillar lumps together savings for retirement using employer-based plans and/or accounts for individuals. Pillar 3 includes workplace registered pension plans, RPPs, private personal savings, registered retirement savings plans, RRSPs, tax-free savings accounts, TFSAs, and taxable non-registered investment accounts. We believe this is the most critical pillar and why our agents dedicate so much time with clients and prospective clients to educate and show them the available options. Understanding the right balance between what you spend now and what you save for later is important. Try to be intentional with your spending as with your savings. Think about establishing a spending plan. Mapping out your expenses may help ensure that you spend money on the things that add value to your life and still have money to add to your savings account at the end of the month. Working with a WFG financial professional may help you find the best way to prepare for your financial future. Visit worldfinancialgroup.com today.